markets. Now, we are expecting quite a few attendees from several countries today, so while we wait a little longer for others to join, I'll run through some housekeeping before we get started. Firstly, you'll notice that your lines are muted and your cameras are turned off. Our cameras will also be turned off during the presentation just to minimize any technical disruptions, but also to allow you to focus on the presentation slides. On your screen, you'll also notice you can submit questions and the Q&A via the control panel at the bottom. Try and get through as many of them in the section at the end. And also you should see a resources tab on the control panel, and if you click on that, there's 3 tabs at the top of there, one being links, and that's where we'll be posting a link to our website and our blog, where you can find the report that we're presenting today, as well as other research from our team, like our FX weekly report. And you can also sign up to our daily market reports as well. Now, for today's webinar, as you can see on the next slide, our speakers are myself. I'm George, the lead FX and macro strategist based in the UK. And we've got Ruta joining us as well today, our G10 FX and macro strategist, also based here in the UK. And in terms of the agenda, I'll be providing an overview of the global economic outlook, highlighting the most important key themes dominating the macro space and influencing financial markets. And then I'll hand over to Ruta to go over the currency market overview and forecast scenarios from North America, specific focus on the US dollar, before I then go over the UK and the pounds outlook, and then we'll finish off with the Q&A. So before we get stuck into the detail, we do like to provide a high-level overview of some of the key insights from our research here at Convera. So here we are. Basically, the US dollar has had its best start to the year since 2015, and that's thanks to the outperformance of the US economy and the pushback by US Federal Reserve policymakers against rate cutting expectations in the first quarter of this year. The British pound has also had a strong January compared to other major currencies, supported by an uptick in UK inflation that we saw in December and stronger activity data as well. And that led to hawkish repricing in Bank of England interest rates, which supported the pound. But sterling dollar failed to break above 128 and has been moving in an unusually tight trading range for several weeks now. And Europe, the concerns around the economic growth out there, with a slowdown in Germany in particular, weighing on the broader euro area. That's the main reason behind the euro's worst start to a year in 9 years. Whilst the Aussie dollar, often seen as a proxy for China due to its close trading relationship, that's endured a tough start to the year as well. And that's despite markets pricing in fewer rate cuts down under. And this is mainly due to the struggling Chinese economy, the property market worries out there, and continued weakness in Chinese equities, which of course stands in stark contrast to what we're seeing over in the US with the resilience and the surging stock market. And we'll cover that in more detail later. Moving on to the February risk events calendar next, and this is important because the timing of interest rate cuts, which is really driving market volatility at the moment, is so dependent on economic data. So the calendar of key risk events to consider for February here, and some of the key events to call out include the publication of labour market data. That's because labour markets do remain historically tight in many countries, and that's making it harder for central banks to think about cutting interest rates. A prime example of that is the US non-farm payrolls report that we saw last Friday. It smashed expectations and led to the bets on rate cuts being slashed, and therefore it sent US yields surging higher and the US dollar appreciated sharply across the board. So jobs and wage data, highly important, and we have those coming out from Canada this Friday and from the UK next week. And of course, inflation, another important data point influencing policy decisions, therefore rate and FX volatility. And we've got some flash prints out from the US and the UK next week, and that will help define when the Fed or the Bank of England start cutting interest rates. So although it's been a bit of a quieter week on the data front this week, we have a lot going on, a lot of top tier prints next week to be aware of, and any of these might trigger some volatile market reactions similar to the one that we saw after the US jobs data. So important to take note of these risk events and how they might influence policy decisions. Now, the global economic outlook section next, we're discussing some of the key themes and key events that we're keeping a close eye on and what could happen in the future. But before looking ahead, it's useful to take a look back and understand how we got here first, because it was last October actually when we saw this a peak in US yields, a peak in US dollar strength. Global stocks had suffered a 9% decline in the 3 months prior. And then we saw a big turnaround. There was a huge turning point in November. It was the best month for risk assets in 12 months, and that extended into December after the G3 central banks like the Fed, ECB, and Bank of England decided not to keep raising interest rates higher and even hinted at cuts on the horizon. We also saw inflation surprising to the downside in the US, Eurozone, and UK as well, and that supports this that supported that narrative, and it supported global risk appetite. So that brings me on to the first theme, which is inflation. And for those of you who have joined our webinars over the past year, you'll know this has been a topic, a key topic or constant theme throughout the series, and it's because it holds so much weight for central banks and households and companies, and of course financial markets. And as we know, and as you can see from this chart, inflation in advanced economies peaked towards the end of 2022, and it's been falling since. And we called out last year that our leading indicators were pointed to inflation falling faster than the broader market consensus, and that has happened really. And that's why markets ended last year so focused on the potential for more rate cuts coming into this year. However, we've got to be wary that although we are seeing headline inflation falling across the world, the threat hasn't subsided completely, and rate cuts might not transpire as quickly as and as aggressively as markets are expecting. We have seen investors adjust their rate cutting bets already, as I said, within the US in particular over the last couple of weeks, and this has triggered volatility across other markets like currency markets, as I mentioned, after the blowout US jobs report, for example, that led to the probability of a rate cut by the Fed in March falling from 40% to just 15%, and that strengthened the US dollar as a result. But from an inflation standpoint in particular, we're also cautious of a potential bigger bounce back in goods inflation globally. And the reason being is because of the high geopolitical tensions that we've seen and leading to the doubling of shipping costs recently. But also other events can exacerbate this. For example, extreme weather events. We've seen them cause havoc in the past on supply chains. And currently we've got a really dire drought going on in Central America, leading to water levels in the Panama Canal to record low levels, and that could lead to further lead delays, cuts of daily traffic, and therefore an increase in shipping costs further. So something to bear in mind there. And then finally, of course, the stubbornly high services inflation is another risk on the radar, and this is particularly the case for the UK, where services inflation, the falling of service inflation is lagging other advanced economies. One reason for this in the UK, with the services inflation being sticky, and elsewhere really with services inflation, is elevated wage growth. And that leads us on to our next theme, which is this wage growth divergence. Because although we're seeing in the US, for example, that wages are falling in line with inflation, Europe and the UK are seeing a different story, as you can see on this chart here. And even in Australia, there's been a sharp pickup in wage pressures lately, and that's led to a slightly more hawkish Reserve Bank of Australia that we heard from this week. And the other thing that we're watching closely is the potential for central bank policy divergence in light of this, therefore, being driven by wages as opposed to inflation. And this could drive more volatility and also FX trends in the future. And that really supports our thesis of a stronger British pound and Australian dollar for this year, because the Bank of England and the Reserve Bank of Australia may not cut interest rates as aggressively as their central bank peers, and that would provide their currency's yield advantage. But having said that, as it stands right now, despite markets pricing in less rate cuts by the Bank of England and RBA compared to the likes of the Fed or ECB, for example, we've still seen that both the pound and the Aussie dollar have struggled against the US dollar so far this year. But really, that's probably as a result of the sheer economic exceptionalism that we're seeing over in the US. But essentially, what we saw in January anyway was a reversal of the November pivot point and the November-December regime, if you like, which I mentioned earlier, which brings me on to that third theme that we have here, which is the policy pivot that's expected. So as I mentioned earlier, back in December, markets were pricing in aggressive rate cuts, almost 700 basis points of cuts priced in for G3 central banks, as you can see on this chart. But there's been some pairing of those bets in January and February, and the outperformance of the US economy in particular, resulting in a hawkish repricing of Fed rate expectations. That hard data coming out from America continued to beat expectations. And so it's really tough to follow through with our forecast that we had in our annual report of a mild US recession this year. After the jobs report that we had on Friday, on Monday, we saw some data showing the US services sector expanded in January by the most in 4 months, helped by a pickup in new orders and employment. And because of this, less than 120 basis points of Fed easing is being priced in for this year, and that's down from 150 basis points at the end of last year. So in simple terms, markets are forecasting around 4 rate cuts by the Fed as opposed to 6 now, but this is still more than the 3 cuts that the Fed is forecasting. Ultimately, what we're trying to say here is that markets probably got a bit too excited about the whole rate cut situation. And now the incoming data and central bank policymakers, not just in the US, but across other central banks, they're helping to push back against these rate cutting bets by the market. But still, due to the easing recession fears that we have at the same time, particularly in the US, we are seeing global equity markets push even higher in the face of, and even in the face of these higher yields that we've had recently in the US. So the S&P, for example, the benchmark in the US benchmark stock index, that hit a fresh record high last week. The European stocks 50 hit a 23-year high, both of them up over 20% since 2021. At the same time, though, as this interesting chart here displays, the story is very different in China, which is our event in focus slide here. The Chinese New Year and also related to that, the much anticipated annual parliamentary gathering, the 2 sessions as it's called, and that's in early March. But as you can see on this chart, Chinese stocks have been really struggling with the SCI and the Hang Seng Index shedding around 40% of their value since the beginning of 2021. And they suffered some intense selling pressure over the past couple of weeks as well. So the pressure is mounting on Beijing to act more quickly and also more resolutely, because this is posing a greater threat to financial and social stability, we've got to bear in mind. So will we see a big turnaround in China? Because really this chart is emphasizing that widening divergence in economies and particularly equities between the world's 2 biggest economies. But why are we seeing this? Well, we know about the strength of the US economy and stock markets, but in China, obviously the collapse in the property market activity, that's contributed massively to the underperformance that we're seeing in Chinese shares. And this year, we've already seen the property group Evergrande go into liquidation. But aside from that, as a whole, China has had a much weaker than expected post-COVID recovery, and it's really struggling from more structural risks as well, such as high youth unemployment. That's 21%. It's a record high. We also have an aging population, which is a worry with the low birth rates. We've had a second successive year of a population decline in China. And the thing is, without any major market reforms, China could be stuck in this so-called middle income trap, whereby emerging economies grow quickly out of poverty only to get trapped before they reach high income status. But adding to all of this, because of China's stubborn embrace of that zero COVID policy that they had, that exacerbated the economic slowdown that we're seeing, and they're really struggling to recover from that because of the impact on confidence and the domestic spending. And because of this, we've seen some weaker inflation out there. Consumer prices were weak for the most of 2023, and there is an outlier risk of the deflationary spiral out in China. And it's important to realize the negative impacts this is going to have on the wider economy as well, because this weakness from China may, or arguably has had that held back the economic recoveries of close trading partners, as I mentioned, like Australia, but also the likes of Germany as well, that showed no growth in the best part of a couple of years, weighing on the wider Euro space. And as a reminder too, when it comes to the currency impact that this has, something to bear in mind, and we highlighted it in our Are You Ready for 2024 report, this historical pattern that suggests that to really see a strong recovery in riskier currencies or pro-cyclical currencies like the euro and even the pound, we do need to see a stronger Chinese recovery, especially in the manufacturing sector, to give the euro in particular a better chance of appreciating significantly against the US dollar. We have had some positive news out over the last week or so from China, though. Some more aggressive stimulus, $280 billion planned to be released into China. We've had some short selling of China stocks have been partially banned, and the people's and the Chinese central bank has cut the reserve rate requirement to its lowest in 17 years. But ultimately, you know, what's going to drive the stock market and economy, it has to be in the form of improving fundamentals. So the key risk or key event that's upcoming is whether we hear, and we probably will hear, some new policy measures to address this issue after the Lunar New Year. And whatever happens is likely to have a wider bearing on the global growth outlook as well. Not just China, but other economies or nations that are dependent on China, like I said, Germany in particular. And finally, from me today, from the Global Economic Outlook, is related to geopolitics. We're not going to go into too much detail on this today, but obviously it will be a running theme throughout this webinar series. And we highlighted it in our Are You Ready for 2024 report as well, because politics and geopolitics do cause a lot of volatility in financial markets. So it's a key theme to bear in mind, especially this year. Obviously, we've got the ongoing war in Ukraine, and we've got the rising tensions in the Middle East. And of course, we've got the upcoming elections that we have globally. So we've already mentioned how the escalated tensions in the Middle East and the disruptions that we have in the Red Sea, of course, a spike in shipping costs. They've also fueled wild swings in oil prices as well. But in general, the impact on FX markets has been relatively muted so far, and also implied volatility levels remain compressed in the FX space, but also in the equity space. But we do think that this might not last for too much longer, given how long it has lasted, or how long this low level of volatility that we've witnessed has lasted, especially given the upcoming political events. Because aside from these geopolitical risks, of course, politics of that more usual fashion can also drive big moves in markets. And we've got more than 60 countries that equal over 50% of global GDP. They're going to be voting in the national elections this year, including here in the UK, of course. But that one election that stands out is the US election due in November. And this chart here just shows that it's important to remind ourselves that policy uncertainty tends to rise in the months prior to a US election. And all too often, this is a negative driver for sentiment. And therefore, it doesn't bode well for your riskier assets and currencies, but it does bode well for your safe haven assets. So it could be supportive for the likes of the US dollar, the yen, and gold, for example. But yeah, we'll be covering this theme in more detail over the course of the year as things develop. But it's sensible to keep these kind of future risk events in mind, because of course, any organizations trading internationally, when it comes to planning for longer term projects or agreeing invoice costs in foreign currencies in the future, it's prudent to consider the possibility of big swings in exchange rates in the build up to, and also the aftermath of such high profile events like we have looming. So that's the overview of the global themes and events to be aware of from me. We discussed how inflation has been falling across advanced economies, but the upside risks that are starting to grow, how wage growth divergences are also growing, which could lead to policy divergence and FX volatility. We discussed how the US continues to defy recession, helped by the particular resilient consumer and strong labour market, and now how this might force a rethink on the pace and scale of interest rate cuts. And we've touched on the divergence between the US and China, and of course the geopolitical uncertainty that could shape macro and market outlook over the longer term. But in the short term, the broad view is still quite a positive one, namely the recovery that we're seeing. Pro-cyclical assets are on the rise, coupled with the policy easing by central banks that's expected in the second quarter onwards, should support risk sentiment going forward, and eventually lead to a weaker US dollar. But I'll hand over to Ruta now for some more specific currency insight focused on North America first. Over to you, Ruta.
Thank you, George, for setting the scene with such a great update on the recent macro trends driving the markets. And good morning, everyone, and good afternoon, everyone, for joining us. So to kick off the update on the North America trends, I'd like to first start by analyzing the recent volatility trends observed in the US dollar and the Canadian dollar denominated currency pairs. So the heat map here in front of you is based on a 90-day and year-to-date timeframes, showing highs and lows for a list of 10 currency pairs, their respective trading ranges during these timeframes, and also the latest positions within the ranges as of right now. So looking at the year-to-date volatility measure first, dollar-yen has kicked off the year as the most volatile currency pairing, having deviated by 5.7% from peak to trough since the start of 2024. And most of the volatility has been driven by the divergence between the monetary policy regimes across the two nations, or rather the volatility in the pricing of the expected policy rate trajectories. Dollar peso next has also seen sizable realized volatility as of late, with the year-to-date trading range registering around 3.6% as of the time when we published this report. And the pair remains predominantly driven by the differences in the interest rate set by the Bank of Mexico and the Federal Reserve, and also elections in both nations that George mentioned earlier. Later this year could see volatility in the dollar peso pick up from Q2 onwards. So moving on to the two neighbors next, dollar CAD is currently sitting at the bottom of the table as volatility remains subdued thanks to somewhat evenly matched monetary policy expectations going to the first quarter of the year. USD CAD does remain somewhat of a function of US macro developments, given an otherwise weak Canadian economy, and is also exposed to repricing of Fed's rate cut expectations. So although the US dollar is currently trading in the upper quartile of the year-to-date price range, the loonie is seen as holding its own, and the pair is actually skewed more to favor CAD on the 3-month basis. And looking at the bottom of the table, we have dollar CNY, cable, and euro dollar registering the lowest volatility across the USD denominated pairs in this list, with the bid high to low ratio on the year-to-date range at around 2% or below. And specifically, Euro registered the worst start to the year since against the US dollar since 2015, and is currently trading in the bottom quartile of the 2024 range. So moving on to the next slide, I'd like to spend the next few minutes evaluating the relative positioning of the currency pairs to help gauge their fair value versus their respective short and long-term moving averages. And at a high level, as you can see from the table, the US dollar is enjoying strong demand at the beginning of 2024 and has appreciated against all the currencies displayed here on the screen. In fact, the greenback has risen against 77% of its peers in January, which stands in a stark contrast to how it ended 2023, having closed out the year up only against 10% of the currencies. So starting at the top, the US dollar appreciated the most against none other than the Japanese yen on the year-to-date basis. However, more impressively, dollar yen is trading a whopping 23% above its 5-year average, as the stark difference between the two monetary policy regimes continues to batter the yen. So on one hand, we have the Federal Reserve, which maintained the policy rates unchanged at multi-decade highs, and over the past week has continued to aggressively push back against market pricing of early rate cuts. And on the other hand, we have the Bank of Japan, which has also decided to maintain its policy rates unchanged. But contrary to the rest of the world, it maintained the benchmark policy rate at multi-decade lows of a negative 0.1%, without giving investors any real hints about when a supposed interest rate increase might come, given the fact that cooling inflation complicates the exit from its currently extremely dovish stance. So next down, we have dollar peso, which appreciated close to 1% above its year-to-date average. But on the contrary, the US dollar continues to trade at a sizable discount against the Mexican peso when compared to its 1, 2, and 5-year moving averages. And that's thanks to a positive policy rate differential favoring the peso in absolute terms, given the fact that the Bank of Mexico policy rate currently stands at 11.25%, as to compared to the Fed's funds rate at around half of that. Meanwhile, the Canadian dollar had the worst start to the year against the US dollar in the post-pandemic era, and the greenback continues to trade above most of the short and long-term averages. The Canadian dollar is holding up pretty well, all things equal, when compared to the 12-month basis, and that's thanks to better than expected growth backdrop. So the latest figures reveal that the Canadian economy unexpectedly expanded in November and December months of 2023 against the consensus of flat GDP growth prints. In terms of the euro-dollar pair, as I mentioned previously, the pair had the worst start to the year in the past 9 years. And as you can see here, it's trading close to 1% below its year-to-date average and nearly 3% below its longer-term 5-year average. And the main reasons for the depreciation have been, one, relatively weaker growth backdrop as compared to its US counterpart, and secondly, a recently more dovish ECB tilt. So while the bloc did manage to escape a technical recession by the skin of its teeth at the end of 2023, the momentum going into the first quarter of 2024 does remain weak. And on the monetary policy front, the ECB also maintained its policy rates unchanged at record highs. And while governing council members similarly pushed back against Q1 rate cut bets, it was made very clear over the past several weeks that the central bank's next move will indeed involve an interest rate cut. Finally, at the bottom of the table, we have the APAC duo of Aussie dollar and the New Zealand dollar, both of which have shared over 1% of their value against the US dollar when compared to the year-to-date average. And that's thanks to a gloomy growth prospect and also the struggling Chinese economy. So with that, for the next part of the presentation, let's move on to the FX forecast scenario and dive a little deeper into what we can expect over the next 8 quarters. So here at Convera, we believe that taking a scenario-based approach is more appropriate as opposed to trying to outright predict exactly where the interest rates will end up over a certain time period. And that's purely due to the inherent inaccuracy that forecasters face when attempting to do so. So instead, evaluating various scenarios that might occur in the future and understanding the possible exchange rate outcomes of those scenarios should help businesses identify high-risk situations to avoid or minimize potential losses, but also to identify opportunities to act upon. So focusing on the chart in front of you, the left-hand side shows the historical exchange rate of the euro dollar based on its average weekly closing prices. And the right-hand side shows a forecast fan chart, which has a range of paths that the exchange rate could take over the course of the next 8 quarters based on the exchange rate fundamentals and their respective future trajectories. As a reminder, these forecasts have been created in partnership with the Oxford Economics using a behavioral long-term fair value equilibrium model, which incorporates a range of variables such as interest rates, growth, and inflation differentials, to name a few. So from the baseline, we have then calculated one standard deviation above and below to provide a more central scenario, which is the gray shaded area in the middle, and should account for over 68% of the future outcomes. So looking specifically at the euro-dollar pair and its forecast for the medium and long term, the February forecast remains virtually unchanged from the January ones, given that the spot prices have remained broadly stable at around our current forecast level. We did, however, upwardly revised our near-term projections for Euro USD for the end of Q1 to 109 level, so up by 2 cents from our January projections. And in our central scenario, we see euro dollar remaining broadly stable around 106 to 110 range until Q3 of 2024, with volatility expected to pick up in Q4, hence the widening of the gray area to 105, 113 levels. So for most of the year, we expect Euro USD to oscillate around 108, as we do believe that for now, the pair remains somewhat fairly valued given their fundamentals. And despite the recent volatility in the market pricing for either of the central banks, the expectations in terms of the timing have broadly converged across the G3 banks as of recently, with both Fed and the ECB expected to cut policy rates sometime in Q2 of this year. Therefore, rate differentials are expected to remain somewhat stable when looking at a broader lens, and neither of the currencies should gain significantly over another. On the growth front, we expect the Eurozone to recover and the US exceptionalism theme to dwindle as the year goes on. And beyond 2024, we could see euro dollar appreciate ever so slightly thanks to improving growth differentials. So coming back to the Q4 projections, as mentioned, we do expect volatility in euro-dollar spot to pick up towards the end of the year, and hence the widening in the range of the grey band. And that's due to an expected increase in the uncertainty during the election months in the US, which George covered earlier during the webinar. So as we all know, volatility is an integral part of the foreign exchange markets, and we must therefore consider upside and downside scenarios to our baseline as part of a prudent risk management strategy. So what things should we consider for the upside scenario? Or in other words, what factors could see euro dollar appreciate above the 110 level and into the teal area? Well, to see a sustained exchange rate in such a zone, we would need to see global economic growth outlook to improve significantly and inflation to normalize faster towards the 2% target. As a result, this would boost global risk sentiment and support pro-cyclical currencies such as the euro. On the opposite end, for euro to depreciate below 106 level and to remain there for the rest of the year, we would need to see a deep enough contraction in the Eurozone economy for the ECB to abandon its fight against inflation and cut policy rates to preserve bloc's economic growth. Therefore, such a reaction would lead to a widening in the policy rate differential between Eurozone and the US, and would thus be euro negative over the medium term. So next, let's move on to the dollar CAD pair. And compared to our January forecast, February's baseline has been revised down to around 133 level until Q3 of 2024. So a whole 4 cents lower in the near term compared to a month ago. And past that point, we expect the USD CAD pair to further depreciate towards 132 level. The main reason for the relatively tight and stable range in the medium term is the similar timing in the policy rate easing for the ECB and the BOC. Similarly to the G3 central banks, the Bank of Canada is too expected to cut rates at some point in second quarter, thus more or less in tandem with the Fed. And towards the end of the year, we could see the Canadian dollar gain against the US dollar, given the fact that the BOC is expected to cut a little bit less aggressively than the Fed by the end of the year by around 30 to 40 basis points. In terms of the scenario analysis, one of the factors that could see USD CAD appreciate above the central scenario and beyond the 135 level could be Canada's inflation easing quicker than expected, which would put more pressure on the BOC to cut rates faster and more aggressively than is currently expected. Therefore, the opposite of what I discussed would be true, and the Canadian dollar would become relatively less attractive than its US counterpart. However, on the other hand, the downside scenario for the USD CAD pair could come into fruition if the current reinflation trend that we've seen in Canada recently persists, forcing the Bank of Canada to maintain their higher for longer regime for, well, a little bit longer. So the central bank does remain concerned about the persistent core inflation and specifically high shelter price inflation. Another factor that could also be CAD positive is stronger than expected domestic growth. The IMF does remain optimistic that soft landing is the base case for the world's ninth largest economy and expects Canada's economy to grow at the third fastest pace among advanced peers in 2024. The better than expected growth backdrop would be good news for the Bank of Canada, as it would give the central bank a little bit more breathing space when it comes to the central bank continuing to tame inflation that is currently running hotter than the 2% target. So on that note, thank you for listening to the North America update. And I'll pass you back to George for updates on the recent selling trends. Thank you.
Brilliant. Thanks a lot, Ruta. Obviously some excellent insight there, but for me, especially thinking about the different scenarios for the euro-dollar currency pair and how they could play out, because the euro-dollar currency pair is the most heavily traded currency pair in the world. So therefore, any major swings we see there could have knock-on effects to other currency pairs as well, such as sterling-dollar, because that has a strong positive correlation with euro-dollar. But now I'm going to look at sterling in particular and what's happened and what might unfold in the future. And again, firstly, looking at some of the recent volatility witnessed here. What was really surprising, as I mentioned earlier, was that in January, that small trading range that we witnessed for sterling dollar, just 1.5%. Compare that to the 6% range over the past 3 months. And historically, really, we often see swings greater in sterling dollar cross compared to sterling dollar pair compared to other sterling crosses like sterling euro. So it was a bit of a surprise, but we think the pound was supported by the uptick in UK inflation and the strong activity data as seen with the CPI and PMI data that we had last month, and that helped support sterling demand in the face of the US dollar demand that we had at the same time. So that pair remained relatively stable. But because of this hawkish repricing that helped support the pound against the dollar, it's also why the pound had a strong month against other currencies across the board. It rose to a 5-month high against the euro, above that 117 mark, and sterling against the Japanese yen rose to an 8-year high. And overall, as you can see via the majority of the teal bars on the right there being above the 50% mark, the pound is trading in the top half of its year-to-date and 3-month ranges against most of these peers. And in fact, the pound has risen against 80% of its global peers over the course of the last 3 months. And as I said, it's mainly because of interest rate or yield differentials moving in favour of the pound, making it more attractive. But as we said on these webinars before, the pound is also a risk correlated currency. Therefore, in a so-called risk on environment where traders take on more risk in search of more reward, the pound is deemed one of the most attractive in the G10 space. And because we've seen such an uplift in global equities, it's no surprise that the pound's been supported with those riskier assets. But we are aware that there's been a slight breakdown in the correlation, particularly over the past month or so, in that equities have surged a lot higher compared to how much the pound has strengthened. As I mentioned, it's been relatively flat versus the US dollar. But this has largely been more of a strong dollar story as opposed to a weak pound story. And more importantly, From a technical perspective, sterling dollar trends or trades closer to that 126 mark. It's broken below its recent trading range that I mentioned and below some key moving averages that were acting as support. So despite the rebound that we have seen this week, it does arguably open the door up to some short-term downside risks for this currency pair, although our longer-term view is still for a recovery of the pound against the dollar. On this next slide, again, we're looking at the value indicator analysis, so we can see where sterling crosses are relative to long-term averages. For example, we can see that sterling dollar is currently still above its 1 and 2 year average rates, so could be seen as a good opportunity for any organizations that have exposure to the US dollar and needing to buy US dollars. And if we look at the sterling euro exchange rate as well, opportunities lie there. You can see it's further down the table, but it's still almost 2% above its 1 year average. And if you look to the right of the table, it's almost 2% above its 5 year average as well, that 5 year average being at 115. So right now, current positioning on sterling euro could be seen as a decent opportunity for hedging future euro purchases. That is when you compare it to the long-term averages anyway. And if you look at sterling versus the Japanese yen, it's always a big story that we point out on these webinars, because it's 10% above its 2 year average and a massive 22% higher than its 5 year average, as Ruta mentioned, because of the Bank of Japan continue to keep interest rates at record lows. And yes, this trend isn't showing any sign of a reversal just yet, but if you are a business in need of buying Japanese yen and have the cash flow to buy and keep those yen in a holding account, for example, which we offer, then these rates should be seen as highly attractive, or even hedging at these levels is an option too, of course. But the rate differentials mean you'll be stung heavily on the forward points. And obviously, we appreciate organizations are going to view these certain exchange rates and hedging opportunities differently. And that's why we're trying to provide as much data-driven insight as possible to support the conversations that you have with your points of contacts, your account managers and your corporate hedging managers here, to put a bespoke currency plan in place. And when it comes to currency planning, our aim is to help businesses identify and assess the drivers of the risks and opportunities in exchange rates, but also to understand their own risk appetite and tolerance, their business objectives as well. And then that allows us to help develop and implement a currency strategy. And evaluating various scenarios, like Ruta mentioned, various scenarios that may occur in the future, and understanding the possible exchange rate outcomes based on those scenarios, we believe it will help with this process of putting a risk management plan in place. And as you can see from this slide here, looking at sterling against the US dollar, the possible future scenarios, following on from what I said earlier, we see a downside risk in the short term for sterling dollar, but then a modest recovery through to the end of the year and beyond. And this is really based on the timing and the scale of rate cuts predominantly, i.e. what we're seeing now, that markets are adjusting to the fact that the Fed might have to delay those rate cuts until the summertime or end of spring. But when it does cut, it will cut rates more than the Bank of England, therefore giving the pound a yield advantage. The top end of the central range, the grey area on the chart, that displays the confidence interval around 68%. The exchange rate is going to fall somewhere within that range. So by year end, between 130 and 120, obviously still a big range to bear in mind there. But our view is that from the market insights team is that the sterling dollar exchange rate will stage a shallow recovery throughout the year as US economic strength starts to cool. From a more technical standpoint as well, sterling dollar does remain over 20% below its average rate of the 21st century. So it gives us a bit more confidence in the pound's potential to strengthen from these kind of levels. But of course, it's not going to be a smooth journey. We do expect some volatile price action, and data remains highly important. The economic data remains highly important for central banks' policy decisions, and therefore interest rate pricing, which is a key driver of trends in exchange rates. But we do think the pound is going to gain or should gain real momentum because of that interest rate differential favouring it. But to really gain some upward momentum and shift into the higher bounds that you can see on this chart is really going to depend on whether or not in this high interest rate environment that we currently have, that UK economic growth is robust as well. And alternatively, if we don't see that, if we see this high interest rate environment but a low growth environment for the UK, that's probably going to limit the pound's appreciation. And it's something to bear in mind as something that we're wary of, that's going to hold back the appreciation of the pound for this year. And it relates back to what I said earlier, turning structurally positive on the pound, in that we need to see global growth pick up considerably, and that's going to have or depend hugely on whether or not China's recovery gains some steam, particularly in the manufacturing sector. We need to see that pick up substantially if we're going to see any multi-year highs for cable unfold again. But of course, we've got to be wary of black swan events as well. They can happen, they can shake up markets massively, as we know. Some of these events, perhaps an escalation of geopolitical tensions, perhaps a huge unforeseen rebound in inflation, for example, that hits global risk appetite and sends sterling dollar exchange rate back under 120. It's not impossible. You can't rule out these moves. They can happen, and they have happened in the past. So it's certainly something to bear in mind when putting your currency plan in place, especially when we expect volatility to pick up by the year end due to the elections that we have in both the US and the UK. And then finally, if we move on to sterling against the euro, as ever, these forecasts on this currency pair do look even more extreme. I appreciate that. So I recommend just focusing on the grey area here, indicating a range of still quite big 121 to 110. But the baseline forecast of around 116, we expect the exchange rate to fluctuate around this kind of level in reality. But again, we are a little bit more bullish on the pound versus the euro, and that's because we don't expect the Bank of England to cut interest rates as much as the ECB, again giving the pound that yield advantage. So all else being equal, or pending any major shocks, we do think the pound has some legs to climb higher. And for me, and as I put in one of our daily reports last week, the sterling euro ended January last month very high with a strong monthly gain, and closed above a key moving average. And that moving average has been quite restrictive for the pound over the last 6 years or so, or longer, sorry, 8 years since 2016, since the Brexit vote. And the fact that we've held above that level now is a strong bullish signal for me from a technical standpoint. So we could see the likes of the 118, 119 over the next few months. But of course, we have to be wary of any shocks. We can always be certain of uncertainty disrupting this, and things can change drastically, which is why we try and keep everyone abreast of what's going on with several research pieces, our daily reports, our FX weekly as well, and of course these webinars that are held on a monthly basis. Before we do, we'll wrap up, but just one note from me, that we can produce these kind of currency forecasts for hundreds of different currency pairs. So if you have any other currency pairs in mind, do reach out to your account manager, and we can provide that further insight for you. But that's it from the presentation side of things. So thank you for sticking with us so far. But we've got some time for Q&A now. So remember to submit your questions using the control panel. Ruta, I think there's one already in here for you. So I'll pass that over to you, especially given your coverage on Canada as well in this webinar and in our daily market reports. So the question is, where do you see Euro CAD in the next 6 to 12 months?
Awesome question. Thank you, George, and whoever sent it. So just as of yesterday, we did see EuroCAD touch a fresh 16-week low, and that's been on the back of Canadian economy outperforming the market expectations. So as I already mentioned earlier in the call, some recent data prints have showed that the Canadian economy did expand in both November and December months, against the consensus of flat growth prints. And Canada has also posted the strongest PMIs in the past 3 months. However, they still do remain in the contractionary territory. On the flip side, the Eurozone bloc continues to struggle in January as consumer and business expectations remain subdued. So that's in terms of the growth backdrop. And on the monetary policy aspect, there's also more pressure on the ECB to cut rates sooner than for the Bank of Canada. And markets expect the ECB to cut rates more aggressively than the Bank of Canada over the course of 2024, which has contributed to the EuroCAD downward trend as of recently. However, looking at the broader picture, the EuroCAD pair volatility does remain low, and it has been one of the least volatile currency pairings in the North America region, looking at the year-to-date picture, which is probably what you picked up in the FX volatility table that we showed on the screen earlier. So that's sort of in terms of the backdrop for the currency pair dynamics. And going back to the question, and where do we see the pair in the sort of medium term next 6 to 12 months? Well, we do expect the weakness in EuroCAD to persist into the rest of the year and beyond. And that's based on the two drivers that I've just described. So the improving domestic growth outlook and higher policy rates that are in favor of the Canadian dollar. And numbers wise, our baseline projections for the EuroCAD pair do deviate around 144 mark for most of the year, and we are expecting the pair to depreciate a little bit slightly to 143, 141 levels in the first half of 2025, but that's sort of beyond the time frame that you've asked. So I hope that answers your question. So thank you for sending that through. And looking at the chat box, George, I see there's one question for you that pop up. Hopefully you're going to be able to answer. So the first one is, when can we expect the Bank of England to start cutting rates?
Yeah, cheers, Rita. I saw that one. It's tough to pinpoint exactly, obviously, with markets pricing all over the place as well. But we're thinking the June meeting's probably the most likely, and that is more in line with the market expectations as well. As it stands, the pricing is that the rates are going to remain the same at the March meeting at 5.25%. There's a 35% chance of a cut in May, but a 60% chance of a cut in June. So we're sort of in line with that June meeting being the move. And if you remember last week, we had the Bank of England's meeting, and all eyes were really on the vote split, and that came in at 6-1. So 6 voting to keep rates as they are, 2 voting for a hike again, but 1 voting for a cut, and that additional 1 voting for a cut means that that door has been open for that policy pivot. But that policymaker is one of the most, or is the most dovish out of the Bank of England, so it wasn't a major surprise. But the BOE did drop its tightening bias, removing guidance that it's going to have to hike rates again. So we don't think that's a likely scenario, and it was reinforced by acknowledging that keeping rates as they are for the time being is restrictive enough to push inflation to the 2% target by the end of the second quarter. Of course, it's very much dependent on inflation at this stage, though, and obviously, as I mentioned earlier, services inflation has been sticky. If it doesn't fall quickly enough, then we could see a delay to cutting rates more. But for now, we do think that the June meeting is going to be the meeting where they first start to cut. And there's another one coming in relation to when the Fed is going to cut, or how many cuts there are going to be. What if it doesn't cut the rates by the summer? There's a few questions that come in, so I'll combine this answer or combine those questions and answer it in one go. We obviously heard last week from the Fed push back against the market pricing of too many rate cuts this year, and with the data that's come out, we do think that that's been justified, and the markets just got overexcited by pricing in too many cuts from the Fed. But the irony is that the pricing of rate cuts that we've seen makes the need for an actual policy rate cut less urgent by the Fed, because financial conditions have actually eased quite a bit since early December because of markets pricing in these rate cuts. So it's actually doing some of the work for the central banks, for the Fed, i.e. supporting growth and pushing up those inflation risks. And consequently, the more aggressive the market prices future rate cuts, the less need that those rate cuts will be. But we still think the Fed is going to cut rates to avoid a soft landing or an economic downturn. And the thing is, we do think inflation is going to continue to fall, and therefore real interest rates are going to rise without any rate cuts. So to preempt that negative impact that it's going to have on the economy, the Fed is probably going to cut rates, and we do believe that it's going to be probably in the May meeting, but it could be pushed back, and we do think that it's going to be 4 rate cuts in line with what markets are pricing. But as I said, that's slightly more than what the Fed is currently forecasting. However, we have to bear in mind, as I said, the reflationary risks that we have. They can't be ignored. The uncertainty regarding the geopolitical backdrop, the higher shipping costs, supply chain frictions. You could see an inflation re-accelerate, and that's going to deter rate cuts as well. In terms of any currency impact, if the Fed doesn't cut rates by the summer, it's going to definitely catch markets by surprise and lead to higher US yields and a stronger US dollar, much like what we've seen over the past month or so. And in terms of any particular impact on a currency pair, sterling dollar, for example, it could move down into the low 120s, particularly if the US economy remains robust relative to the UK. Ruta, any thoughts on the US dollar impact in this scenario if the Fed doesn't cut rates by the summer?
Yeah, absolutely. So perhaps I can combine and touch upon CAD and sort of euro impact of any delay in Fed rate cuts. So if the Fed was to keep rate cuts, if the Fed was to keep rates higher for longer, that would certainly benefit the US dollar, as George just mentioned. And we have seen this during the the currency trends this January with the pullback in rate cut expectations that did lead to US dollar appreciating over 77% of its currency pairs. Specifically for Euro USD, such a move could lead to a depreciation in Euro USD pair, more towards the downside scenario of our range. So towards 106 level and potentially below. Equally, US dollar CAD could rise further from the current levels and towards the upper range of the forecast chart that we presented earlier during the webinar, so above the 135 levels. And that's mostly because the US economy is holding up exceptionally well compared to its peers, or else all being equal. And even if this expected to slow and is expected to slow down later this year. So neither Eurozone or Canada have that cushion and will have to cut rates regardless at some point in the summer, so not to damage their respective economies too much. So overall, the widening rate differentials would lean more in favor of the US dollar in such case against both the Canadian dollar and the euro.
Cool, thanks Rita. And thanks again to everyone for the questions, but I'm going to have to respect the time and end the Q&A there. But obviously, any more questions, feel free to contact us or contact your account manager, and do keep ahead of what's going on with our daily market reports. For example, that has a lot of insight in there. A few final remarks before ending today's session. So firstly, if you're interested to learn more about our many solutions on offer as well, then do reach out to your point of contact at Convera. Maybe you want more information on how you can protect against currency volatility, or how you can diversify into alternative markets, or even talk to us about automated global payment solutions, compliance controls, or even fraud prevention measures, for example, as you can see here. And secondly, whatever email address you use to register for this webinar, you'll automatically receive the recording within 24 hours from Currency Combo, so do look out for that. And finally, please do take some time to complete the exit survey. It helps us, so provide some feedback to us, recommendations for what you want to hear about in the future, because remember, this is a monthly webinar series, therefore the next one's going to be in early March. So thank you again for joining us today, wishing you all the best, and see you next time. Cheers.